Most people believe investors lose money because markets crash. It sounds logical. When prices fall, portfolios go down. Fear spreads. Headlines get worse. So the crash gets blamed. But this explanation is incomplete. And more importantly, it's misleading. Because market crashes by themselves are not what destroy most investors' wealth. What actually causes people to lose money happens after the crash. It happens in the decisions investors make when fear takes control. Let's start with a simple truth. Market crashes are normal. They've happened for decades across every country, every asset class, and every generation of investors. Stocks don't go up in a straight line. They never have. Yet every time markets fall sharply, people react as if it's something new, something unexpected, something permanent. During a crash, prices fall fast, but falling prices don't automatically create permanent losses. Losses become permanent only when investors decide to sell, and that decision is almost always driven by emotion, not logic. Fear changes how the brain works. When prices drop, the human brain shifts into survival mode. Short-term thinking replaces long-term planning. Avoiding pain becomes more important than future gains. At that moment, selling feels responsible. It feels like control, but in reality, it's often the most expensive decision an investor can make. This pattern repeats again and again. In 2008, markets collapsed during the global financial crisis. Millions of investors sold near the bottom, convinced the system was broken forever. Those who sold locked in losses. Those who stayed invested eventually recovered, and many went on to reach new highs. The same thing happened in 2020. Markets crashed faster than ever before. Fear was everywhere. The world felt uncertain. Once again, investors rushed to sell. And once again, markets recovered far sooner than most people expected. And in 2022, it happened again. Rising interest rates, inflation fears, endless negative headlines. The story was different, but the behavior was identical. Fear leads to selling. Selling locks in losses. The mistake isn't the crash. The mistake is reacting emotionally to it. Most investors don't lose money because they choose bad investments. They lose money because they abandon good investments at the worst possible time. This is why timing the market rarely works. To succeed, you'd need to be right twice. You'd need to sell before the crash, and then you'd need to buy back in before the recovery. Missing just a few of the market's best days can dramatically reduce long-term returns. Yet fear convinces people they'll somehow get the timing right next time. They rarely do. Patience sounds boring. It doesn't feel productive. It doesn't feel intelligent. But in investing, patience is often the most powerful skill there is. Markets reward discipline far more than intelligence. The uncomfortable truth is this. Most investors already know what they should do. They know markets recover over time. They know panic selling is dangerous. They know emotional decisions are costly. But knowing something and acting on it are very different things. In the end, investing success isn't about predicting the future. It's about managing your behavior when the future feels uncertain. The market doesn't punish fear. It punishes action driven by fear. Most investors don't lose money during crashes. They lose it afterward. When patience matters most, they quit. And that decision often costs more than any market downturn ever could.